Hello.
Hello.
How are you?
I'm good. I need to rename myself. Hold on. Oh,
Okay.
Jane.
Well, thank you for joining us live. This is awesome. Hi.
How are you?
I'm pretty good. Good.
Oh, is it
Good
just
to
us
see you.
underneath?
It might be, I don't know. There was several people that RSVP'd, but it's really hit or miss. And so I just usually do it no matter who shows up. And then there's the replay afterwards.
Okay, awesome.
Yeah.
Yeah.
Yeah. But then you can ask actual questions if you have them live.
Okay.
It will be posted on our YouTube channel, so I encourage you not to ask anything too, you know,
Lengthy.
involved, yeah, into your own personal business. We can totally take that offline if you want more in-depth answers for your business, but just know it will be public. But questions are good because then other people can learn from them. So if they're generic, you definitely answer them. But awesome. Well, I'm gonna make sure my phone is turned down. We will get started.
Okay.
So, welcome to Mini Masterclass Thursday. I am Sam, and as always, we are going to discuss a business topic that is generic to all businesses. And of course, your individual industry may have other considerations that you need to know. But today, we're going to be discussing end of year business checklist items because it's not just about your books, end of year and third quarter. This is the last mini masterclass of third quarter, which means fourth quarter is right around the corner. It's next, no, Wednesday? Wednesday is the first, I think, of next week. Oh God.
Oh, it's time
So that's
spring.
fourth quarter. It's here. Like this is craziness. I'm getting my pumpkins out this weekend for sure. Start my fall decorating. So what we're going to do is go through several areas of the business that need some consideration, definitely in fourth quarter, and most of them ASAP, because what you'll find is as you go through these things, you're going to find things you didn't know were there. You're going to find things that are missing. You're going to find things that have never been addressed. You're going to have ahas about stuff you could and should do for 26. So the sooner you start, the better on all of these things. And so we actually do have a resource on our website. If you go to www.pbsaccountingandtax.com, it might not be up yet as we're filming this, but it's going up and it's called the Business Year End Checklist. And so everything I'm going to cover in this mini masterclass will be in that checklist. So you can feel free to grab it. And if you've registered for this class, we'll go ahead and just send it out to you as well.
Okay,
So
awesome.
yes, starting with your accounting. So accounting end of year isn't just reconcile and run your reports because there's going to be some year end specific things that you want to do in addition to making sure that you're actually caught up. Good news is if you're listening to this early in fourth quarter or late in third quarter, you have 3 whole months to catch up. Bad news, if you're finding this later than that, you have less time to catch up. So hopefully this is helpful in either scenario. So first and foremost, you want to follow up on unpaid invoices. Any amount of money that is outstanding to you, if you're not a real retail scenario, now's your time to go grab it. And also, it may be a very good time to do some tax planning on whether or not accrual basis might be a better way for you to file versus cash basis if you are still in cash basis. What happens when you switch from cash and to accrual is that you're able to take credit or take expenses deductions on things you have not yet paid, but simultaneously, you have to then report all the income that you've invoiced for, whether or not you've been paid for it. Whereas in cash basis, you're only reporting expenses and claiming income from what really went through your bank account, what really transpired. In a lot of cases, analyzing this now on your open AR and open AP, so accounts receivable and accounts payable, may lead to a discussion with a tax planner that could be a really good model for you to switch to. And I do have one client that did that at this time last year, and it saved them over $30,000 in taxes on their first time switching. Now, you can't switch back and forth from year to year. So you would want to let your tax preparer know, is this an anomaly? Is this something that my business is trending? It's going to keep on this way? Has your business scopes changed to where this is not now going to become kind of your standard operating way of doing business? All of that they'll need to know, and hopefully they're asking you those questions anyway, so that they can determine, is it great to switch, or are we just going to take a one-time hit, or are there other tax planning strategies we can implement to help you save in taxes? Potentially like buying equipment at the end of the year in fourth quarter, taking upfront depreciation, which has come back, bonuses or hiring or anything like that, that you may be able to take advantage of, IRA contributions, 401ks, things like that at this 11th hour. Another important part about doing these things now and thinking about them now is some of this, you can't do anything about it once it gets to be a certain point in time. Some things you can kind of backtrack and do on the back end later, and some things you just cannot. If it didn't clear your bank account in this year, it's not going to work for you. So you do want to give yourself time to make some pivots and do some strategy work that'll help you on a tax basis at this point. Okay, so overdue bills. This is a great time for you, especially if you're if you've profited a lot and you're kind of in that place where you're starting to get a lot of taxable liability. Pay some overdue bills, or go through and talk to your vendors about when you can pay. Communication is going to be key in keeping up relationships and credibility and integrity with suppliers and vendors, and they are going to want to be closing down their books and closing out theirs. And if you can communicate to them, hey, I'm not going to be able to pay you, or hey, your money's coming soon, or things like that, you're going to have a lot better luck long term, but also maybe be able to do some strategy around that. Are you taking losses? Or can you pay down some debt and then lower your taxable liability, things like that. And then just the communication, giving them a heads up is going to be really helpful. Reconcile all necessary accounts. And what I mean by necessary is every single balance sheet account that is not a fixed asset or an equity account should be being reconciled every single month. Even if the balances are not changing. So for example, if you have a loan account and maybe there's deferred payments, maybe you didn't make a payment this month, maybe it's interest only for a while, the balance isn't necessarily going to change, but you still want to reconcile every month to zero or to whatever the balance maintains to be. And the reason for that is this is where you're going to find so many things that you're going to be like, why is that there? Or that doesn't belong there, or I didn't make this payment, or it's in the wrong account, or the balance doesn't match the source document. And why is that? And then you have to do the research to backtrack. You should not have any negative liabilities or any negative assets whatsoever on the balance sheet. And every single active account that's not a fixed asset, because those would get depreciated once a year and be involved in a year-end journal entry, not a monthly reconciliation, or an equity account, which again is a year-end situation only. You should have a source document that you're confirming its balance to. So whether that looks like a statement, an online portal, an amortization schedule, whether it was made up or not, or some sort of note or loan agreement, that all has to be reconciled each and every month. Now, some people like to do it quarterly, some people do it annually, and that's a huge red flag because you have very little time to catch things like fraud. Sometimes there's statutes of limitations on what you can claim was fraud. If you've been being charged for something for 6 months and you just now are seeing it, you may or may not be able to get your money back for those things in addition to mistakes and the time it takes to then go backwards to find things or do the research or take the time itself to do it in bulk. So every single active balance sheet account needs to be reconciled by the end of this year. If on our website, no, not on that website, on another website we have called Simplified Accounting Management. That's our sister company. And that's where we do all of our training and consulting on QBO and other business matters. But we do have a how to reconcile your entire balance sheet a class that you can review if you don't know exactly how to reconcile things like payroll liabilities, child support, loans, lines of credits, things like that. I'll put that link in the YouTube description. And if you've registered for this class, you'll get the link in the recap as well. Going on from there, physical inventory count. So by the end of the year, if you do actual inventory for your business, you want to have all of that counted and accounted for in your accounting system. And your accounting system balances should match your point of sale balances that say that how many you have on hand. And this is where I start seeing a lot of problems towards the end of the year because in one system or another, people haven't taken the due diligence to do the proper workflow in recording and then distributing their inventory. So that might take some time and might be a challenge ahead for you. So that's one thing. If you don't inventory, but you buy bulk products that you then resell, and you've stuck them in cost of goods sold because you do intend to sell it, what needs to happen is at the end of the year, so as of December 31st, whatever products you have left over need to be no longer categorized as cost of goods sold because they are not, in fact, sold in this tax year, 2025. Instead, what happens is the value of what you have left gets switched into an inventory asset account effective December 31 of 25, and it reduces the amount of cost of goods sold that you had for the year. This is important for a few reasons. Is one, you're not then overstating or overinflating your expenses for the year based on what you actually sold and the products used to sell those or the costs used to sell those things, which helps you analyze long-term what your real margins were, what your real expenses were month by month and for the year. If you have this overinflated COGS, you're not getting real data out of the reporting that's available by looking at that information. Also, it will increase your taxable liability. So just understand how that's going to work on the profit and loss. Once you take the balance of that and switch it into inventory, that will reduce your costs. Inventory goes up then on the balance sheet and does not get counted as a cost in that year. That will increase your taxable liability, which you might go, well, I don't want to do that. But if you don't, you are then actually overstating your expenses in that year. So in an audit scenario, that's always bad because basically that's like sort of tax evasion, sort of, right? Not on purpose necessarily, but it's you lowering your taxable liability so you don't have to pay taxes on it. You don't want that if you are ever audited. Then what happens though is that transfer, right? So from COGS or cost of goods sold to inventory will be reversed effective January 1. And those things now become a cost of 2026 because you will likely sell them in 2026 instead. So you want to keep good records of what you're purchasing versus what was actually sold so that you have this type of data available to you on December 31st. And you can easily go, okay, so I've got $10,000 left in products I bought but didn't sell for 2025. If you're purchasing it anytime after December 1st of 2020, December 31st of 2025, you don't have to worry because it's in 26 anyway. So that should be done end of year. Any unused or duplicated accounts in your chart of accounts, this is a great time to go through and inactivate them or merge them. What this does, it helps you keep your financials clean. It helps you not run out of space in the amount or the limits that you have in your QBO subscription available to you. And it helps you make sure you're not using two different accounts for the same thing, which is something I see so often at the end of the year when reviewing accounts. You'll have like an office supplies and an office expenses. Some things got put in supplies, some things got put in expenses. Nobody knows why or the rhyme or reason. It was just what they picked. But really, we can consolidate and just use one of those. Another thing I've seen, which is really bad, is multiple vendor accounts for the same person. So let's say somebody entered them as an abbreviated version of their name. Somebody entered them with a junior at the end instead of no junior. Somebody entered them as also could be if they had a business name that came in and the business name was recorded instead of their personal name. Whatever's on their W-9 is what should be the only account that you see for them. The reason this is important is 1099s and also analyzing specific vendor spend year over year and margins and things like that. You're not going to be able to get proper data if things are spread out in multiple accounts. So going through your chart of accounts, your vendor list and your customer lists, which isn't necessarily fun and exciting or sexy, but really could help you get some good clarity on your financials, do some consolidation and have accuracy when it comes to year end. If you have just are just finishing your 2024 extension, because you did have until September, 15th to do that, you should be recording or make sure that you have recorded or your tax preparer has recorded the year-end adjusting journal entry. This is when I went back to fixed assets, depreciation, amortization, and equity. Those are the things that get done once a year by a tax preparer so that your tax return matches your books. And that may have just happened within the last 10 days or so on a business return if you're an S Corp, or maybe happening by October 15th of this year if you're an LLC or a sole prop. That needs to be recorded so that your starting balances of 25 as you're completing 25 were accurate, and then your 25 ending balances will be accurate because that adjusting journal entry was done. It could have been done back in March or April, but making sure it's done before you close out 2025 is important. You might also want to get your tax preparer involved if you don't understand how to do journal entries, if they never sent it to you and you don't know how to look and see if they've done it. And simple email, can you either send it to me or confirm that you did it, is a great way to handle that. I'm reading my little notes here. Okay, so close the books for year end. There is a feature in QuickBooks, and I don't know about other softwares, but there is a feature in QuickBooks called Close the Books. It's in the gear icon in the upper right-hand corner underneath the Advanced tab that will pop down in your account and settings, and it just says Close the Books. All that's doing is confirming that every piece of data, including the depreciation posting, the year-end journal entries, all of that have been done for whatever particular year. In this case, it would be 2024. Unless you're really behind, and then whatever the last year your taxes were filed is the one you want to make sure is closed. What this does is it enables you to still put data in, but it will warn you that you are affecting a year that's already been filed and returned and closed. Again, don't close the books until that final year-end journal entry has been posted by either you, a bookkeeper, your CPA, whoever it is, and then close the books. And there is two options when you close the books. One, so it'll be effective December 31st of whichever the last tax year you have filed is. The next option is warn me when a transaction affects a prior year, or warn me and make me enter a password. I highly, highly, highly recommend that you choose the make me put in a password, because it will make you really critically think, why am I changing this information? Should I be changing this information? Should I reach out to ask somebody about what this does if I change this information? And absolutely never give that particular password out so that anybody can just go in and make changes. I have a colleague who his password that he sets for his customers is $5,000, like $5,000, because that's how much he says he'll charge if you mess up a prior year, which is
That's a
kind of
good
funny.
way.
That's kind of funny. So it messes up your tax return, it messes up the journal entries that might have been posted at the year end if you go back and affect prior periods. It could be that you're not supposed to do it at all, and we just make an adjusting entry effective 1/1 of 25 or 26. There's lots of ways it may affect your financials and also your reports going forward. So close the books, put your password in, don't give the password out, or have a meeting with someone about why you think you should be making changes to prior years that have already been filed. There are legitimate reasons, but we want to have that discussion and make sure you're not just going willy-nilly in there without realizing the full circle effects. Preparing your financial statements. So I would highly recommend, I just did this today with a client, run your P&L year to date and your balance sheet year to date and just start analyzing them. Hopefully you're doing this on a monthly and or quarterly basis, and hopefully even with an accounting professional or somebody. But if you're not, and even if you are, run those P&Ls and balance sheets now. Just really look at it. Does everything make sense? Does everything look like it's in the right place? Do the balances and the amounts look right? Is everything reconciled? And you're going to probably find that you can't answer all of those questions to yes. Now you have time to pick it apart and say, let's focus on COGS this day. Let's focus on this balance. Let's see why my credit card is negative. Let's see why this loan balance hasn't gone down, but I've been paying it every month. Or I just today found in a client's file, his 401k deductions are building and building and building and never being paid down. Turns out the bank account he had entered in the 401k software was not the right bank account. Therefore, he has over $7,000 of 401k that he hasn't paid. And by us studying the balance sheet, that's how we found out. It was just something that slipped through the cracks and he didn't realize wasn't being pulled, and that happens. That type of stuff happens all the time. And reviewing your financials will be the way you find all of this. Or the way that you start questioning, does this look right? This doesn't right. This seems off. I had another example of a client who came to us because they had $500,000 in their fuel line item on their P&L. And they were like, I know we did not spend $500,000 in fuel. What the heck is going on? When we got in there and started digging around, we figured out there was a rule that was an automatic rule set by QuickBooks that somebody got what I call click happy. And when it popped up, they just said, sure, yeah, get off my screen, right? They just didn't want to deal with it. Instead of really investigating the rule and deciding if it was the right rule, they said sure to whatever QuickBooks popped up. Well, QuickBooks rule stated that anytime a description contained, that's the word, contained the word ARCO, ARCO, to put it to fuel. And that is a gas station in California, and that seems legit. However, every time they paid their subcontractor, Marco, whose name contained ARCO,
That happened. That
it is.
happened. I just saw it yesterday. Weird.
Right, see, it
Huh.
is, and that's a rule that happens, and that's just something that can happen in the software. But if you're not, the other thing is they had the auto add toggle on, which you never want to do. You want to go through your rules if you haven't already and turn off auto add, because what auto add does is it just allows QuickBooks to decide for you and throw it in your financials. And
Mhm.
until you start really digging through every detail, you'll never see it with your eyeballs. You don't have the chance to stop it. And so in this case, the Marco rule was putting every ACH payment to that contractor to fuel. And
Mhm.
because it was an auto add, it just was going and they didn't know.
I
They
was
also,
wondering why that was happening yesterday. That's crazy that you said that because I just
hey, well,
yesterday.
it's it's the rule.
Yeah.
Now, unfortunately, there is no way to bulk change
That's
all
what
of those transactions for
yeah.
Marco
Yeah.
by vendor name. Therefore, you have to go into every single one and update the categorization. That may take a while if you're finding these types of things out. So when I say prepare your financial statements, it's so that you have time to dig through things that seem really weird and off. Now, there are ways to bulk update categorization. So if you find something that's just been put in the wrong category for a long time, we can do that in bulk. It's the vendor name that is a problem. So, or projects that are a problem or things like that. So just know you have time to deal with it, but you got to find it first. And I'm really glad that you found that now and not in January when everything's going on and you're like, what the hell? Now, do you know where how to find the rule
No,
that
but what I figured that I would do just while you were saying that is to run the report on the fuel and then go in
yes,
there and maybe just flag them all and then do them in
yes.
there.
So in the banking center, so depending on your if you have the new version of QuickBooks or the legacy version of QuickBooks, it's under bank transactions, accounting, bank transactions, and you can go into there and one of the tabs is rules.
Okay.
You can find the rule that's been created. It will probably have like a double square looking icon,
Mhm.
which means it's on auto add. You can edit the rule, you can turn off auto add, and you can really study the rule. And it just delete it if it's crap, right? And if it's not crap, if it's only half crap, fix the rule so that going forward it does what it's supposed to do, which is help you automate, help you streamline, but it doesn't create this mess. And
Okay.
then
So
as long as
right now
auto
it's
add is
continuing, right? Okay.
exact, right now
Yeah.
it's continuing,
Yeah.
right? As long as auto add isn't toggled to on, it'll then be in your bank feeds for you to review with your eyeballs and make sure that it's correct. And then just press add after that if it is. But if it isn't, you then have the opportunity to change it and update whatever is wrong about it.
Right. Right.
And an example of that is like staples. Let's just take staples. Staples could be office equipment, staples could be janitorial supplies, staples could be office supplies. So if you have staples as a rule and everything that hits staples just goes to office supplies, it may be wrong, but you can just change the rule, change the categorization once it hits your bank feeds.
Okay.
Okay, great. Yay. Compare actual to budgeted numbers. If you've set a budget for 2025, you need to at least review in Q4, how are we doing against our budget? You have time to make pivots. You may see based on your actuals that you are so far off track to your goals, update it. A budget is a living, breathing document, and you can update Q4 to reflect what I think we can realistically actually do by the end of the year. And then you're working on projecting 2026 simultaneously now. So start working based on your actuals, what you want to project for 26 or goal set for 26, like increasing revenue, decreasing costs. Do you want to hire? Do you need to fire because you're not getting the revenue in that you expected to support something? Do you need a marketing campaign? All those things. And we're going to talk about several things that go back to the budget and that are important. And again, you have time to pivot and make changes if 25 is not looking like you wanted it to. If you've surpassed and exceeded your expectations to 25, maybe bump those Q4 goals a little bit so you can perform up to your potential and be even that much further ahead for 2026. You also want to look at your projections and forecasting for, I said that, for 26 simultaneous based on your actuals. You have enough data now. You have 3/4 of data now to work with to really understand what the trajectory of the business is. Are you staying plateaued? Are you going up? Are you kind of coming down? Do you want to bring in a new line of service or a new product? And what will that take? And what are those projections at which will help you? At the end of 25, you can then use, if you would like, the 25 actuals in the 26 budgets and then just increase them by percentages or departments or dollar amounts, whatever you want to do. So you're not doing a whole new budget by hand. Collecting W-9 forms. If you have not, and you've paid these people, you should, best practice, always collect them up front. Never pay somebody at all is the best practice until you have a W-9 form and vendor agreement in place, so that in an audit of any kind, it's exceptionally clear that their scope did not determine that they should have been an employee, and you have the proper compliance documentation and the documentation from which you're going to 1099 from or not. Maybe they've marked the box as S Corp or C Corp, and therefore you don't have to 1099 them. Your job is to have the compliance, which is the form from them. Your job is not to decide or determine, yeah, their name has ink in it, so I'm not going to do it. You have to have that form by them, filled out by them, signed by them in order to be compliant. I don't know every single state's fine, but I do know in California, the fine for not having proper documentation on file is $5,000 per occurrence.
Wow.
So ignorance is also not an excuse, unfortunately. So just saying, I don't know, I didn't know this, they really don't care in an audit, and they're just out to do their job, which is to catch the compliance, issues, correct them, and then collect whatever penalties they can around that. So
Woo.
collecting W-9s does not get easier and easier. The closer and closer to the end of the year, it gets harder and harder. There are people out there that don't want to give you one because they don't want to claim the money they're making on their taxes. That is not your problem. That's their problem. You should not get into tangling with that mess. If they don't want to claim the money the way they're supposed to and get their own write-offs, then you work with someone else, because there's lots of people that will follow the rules. And just for note, there are ways to file a 1099 on someone who has not given you their documentation. And I absolutely suggest that you do. That doesn't help you on the retain the form compliance end of things, but what it does help you on is did you report the wages, or not wages, I shouldn't say that, the money that they earned? Yes, you did. Then it's up to the IRS to track them down, figure out whose social security number matches. You can still file the form, and you should, even if they didn't give you the W-9. But start now early, and you'll be surprised that it might take you all 3 months for somebody to get it to you if you haven't done it already. So again, best practice, collect it up front, collect it at engagement, and then you never have to worry about this. Set aside your cash for estimated taxes. Even if you're just now doing your 24 taxes, you may have just found out what is likely that you'll owe in 2020 for 2025 if your business is doing along the same lines as it did in 24. If your business is doing better, you're probably going to owe more. If your business is doing worse, you may owe less. But starting now, putting aside that money, if you haven't already done that, will be important. That being said, there are tax planning strategies that will enable you, if you're a corporate officer, to pay all of your taxes owed through your payroll all year long, or at the end of fourth quarter here, so that you're not having to come up with these large chunks at a time, quarterly or annually. So that's another tax planning situation I would ask about if you have someone doing your tax planning. Is there a way I can adjust my payroll so that I'm paying all my taxes each time versus waiting quarterly or annually to do it? That'll help you spread it out through cash flow. That'll help you budget for it better. That'll help you, get it off your plate and not have that end of the year or April or October 15th panic. Or have to do payment arrangements, which are possible, but do charge you interest, which costs you more money than you're already spending. So those are your accounting end of the year tips to make sure that you're planning for and putting into place. Now we'll go into business organization. If you have SOPs, standing operating procedures, there has likely been updates made throughout this year that are not yet documented. So it would be a great time to spend fourth quarter really documenting any updated SOPs so that going into 26, all the new procedures are there. If you have turnover, the new people are getting the most current version of the workflow versus whatever used to happen. And you may need to even address some training or some, take some time with individual departments based on what those changes are. All that takes time and planning. So doing that exercise is it sucks. It's time consuming. It takes capacity for a minute in time, but it really does help you long term. Setting your business goals for 2026 is a great time to do that now, or even just start thinking of them, writing them down, scribbling them somewhere, putting them on a vision board, whatever it is that you do. Now's the time to start setting those in 26. By the time you get to 26, it's not too late, but it's late in the game to start planning because you can't put the motions in place to get to that unless you already are now setting that goal. Update any mailing address changes. If you've moved, if your mailing address has changed, if you got a PO box recently. This is also true for your employees. Running a check to make sure everybody's W-4 mailing information is correct, as well as your vendor's W-9 information, because two things. You should be getting these updated forms annually. So you get annual updated W-4s and annual updated W-9s, which very rarely happens in real life. I see very few people do this. But the reason that you do that is because deductions might have changed. People may have gotten married or divorced throughout the year. They may have moved. They may have gotten a PO box. A lot of people have mail theft. And so they start going to these mail office locations and getting their mail that way, or a PO box. You want to make sure all this is up to date so that their W-2s and their 1099s go to the right places. And you're not dealing with a bunch of that type of stuff. I didn't get it over now back in February. Or if withholdings have changed or corporate status has changed, especially on a W-9, somebody may have been an LLC last year, which means you needed to 1099 them, but they may have taken the S-Corp election for this year, which means you no longer have to 1099 them. You won't know that type of information if you don't have those forms updated. So making sure all of that is updated. Cleaning your email box. If you can make some rules, if you can make folders, if you can start some automations to move your emails where they need to go, if you can initiate some sort of software like Fixer .ai that actually categorizes and does all that, this is a great time to do that, because then going into 26, you're kind of got that clean slate, fresh breath of air. And if you have an inbox zero goal, you can really start to whittle your way down to that. Standardizing your naming conventions. If you're using 2025 in your naming conventions on documents, obviously you want to standardize that so that the rest of the year it's all 2025, and then switch it in 2026, which should be one of the SOPs that gets updated. Make sure as of January 1 that you're changing the naming convention of files to da 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 da, and make sure that's updated. Cancel any unneeded subscriptions, which will help you if you analyze your budget to actuals or you go through your P&L like we talked about. You might really see, oh my gosh, I'm paying for all these things I don't need to pay for. Or maybe you don't have the same amount of employees and you're still paying for their seats or their email addresses or things that you can get rid of by year end. Reasonable compensation and your accountable plan. So if you are an S Corp officer and you have not yet done your annual reasonable compensation analysis, which determines how much you have to pay yourself in 2025, you should do it ASAP, because you may find that you have a large chunk that you have to come up with by the end of the year. And this gives you 3 months to come up with it versus, doing it in December and you have no time at all. So reasonable compensation is the basis. in which you have to pay yourself as an S Corp officer. If you don't meet reasonable, that's okay, except you cannot take distributions. Therefore, any distributions you may have taken have to be converted to a taxable wage to be put on your W-2 so that you're not showing distributions because you did not reach reasonable compensation. If you're a C Corp officer, you actually cannot pay yourself more than reasonable compensation. That's not allowed. So you need to make sure by the end of the year that you're not paying yourself more than, because if you have no idea what reasonable is and you just decide to pay yourself a certain amount, you may be overpaying yourself as a C Corp officer. So those things, making sure you have the last quarter of the year to address them, take the time and the money to catch up, or just know, okay, I'm not going to make this number. Some people are like, I can't afford to pay myself on payroll. That's okay. You just can't take distributions because those have to be taxed if you didn't meet reasonable compensation. Then your accountable plan. If you are an S Corp as well, and you are reimbursing yourself at for anything, your mileage, expenses that you put on your own personal card that were for the business expenses that are running through personal accounts, anything that like that you're needing the business to pay you back for should be documented in an accountable plan. The accountable plan needs to be updated annually, if not quarterly, based on the operations of the business to make sure that you're in compliance and each shareholder is in compliance with not only the bylaws, but the accountable plan money movement transactions, so that in an audit, a corporate audit, you're not piercing the corporate veil, which then could lead to reassessment of your entity selection, which then could lead to tax implications. So looking at that, did we follow the guidelines? Do we have one? We should have one, especially if we are taking money out of the business and you have time to make those updates end of year. Okay, information and technology. Make sure you have any backups to anything that you need backups. If things aren't living in the cloud somewhere, you want to back everything up before year end so that at least by year end, you have this year's information somewhere. Change any old passwords, make password updates as needed. Personally, in our firm, we just went through and did a whole password update so that at no point in time do we have passwords now that we've had for years and years and years, which was the case. And any kind of hacking situation that could lead to some big challenges for us. So changing passwords in the year is always a good idea, which then you would need to change SOPs and workflows with those new passwords, which all that takes time. Audit your technology and your tech stacks so that you can determine, do we need to keep all of these? Is there a better, more efficient way we can be doing whatever we're doing? Is there new technology available to us that we can implement by year end and take the time to get the training and all the things that need to happen in order for everybody to understand how to work it, how to save old documents and then move them into the new software? I swear to the heavens, it always takes longer than we think it's going to take to implement things. So getting rid of things you don't need, but the implementation of the new things, it's going to take the time, that the whole quarter, I bet you. Assess any upcoming technology needs and make sure they're in your budget. If you're now looking at your 26 budget and you see that there's this big investment that you need to make to get this new software or technology in the office, but that's going to save you tens of thousands of dollars over time down the line, put that in your budget and make sure that you have room for either the monthly subscriptions or see how you can pull back in places to allow you to implement that one. That all aligns back to your budget. I will say also that's another way for you to kind of lower your taxes a little bit is to bring on those large expenses, maybe pay for the consultant to come in and train you if you need a tax write-off. That's a great tax write-off. Software updates and virus protection. Obviously, in the year, a lot of places do updated terms of engagement and things. You just want to make sure you understand what all that is. For your marketing department, brainstorming upcoming initiatives like fourth quarter promotions, that should obviously be almost done, hopefully, but most especially if you do Black Friday, now is the time. It will happen like this, and you want the marketing time and marketing power to make sure you have enough exposure that people will take advantage of those. But honestly, you should already be planning for first quarter 2026 marketing initiatives if you can, or if you're going to have any, because again, the longer you give yourself to actually implement them, the better the results are going to be. And then you can spread the cost over 6 months versus over 3 months budgeting wise on the initiative, because you have fourth quarter through first quarter to do that. Evaluate and update any branding that you would like. A lot of companies decide, okay, we want to move in this direction or that direction, which has to be changed in your Canva, on your website, on your logoing, potentially on merchandise, and all of that is time and money that you need to budget for, both literally and figuratively. Schedule any photo shoots or video sessions of your products that you need, or any kind of podcast episodes, any kind of way you're marketing your business. Start budgeting and getting the calendar filled for those as well. Update any dead links on your website. I can't tell you how many times I've gone to people's websites and I click on something and it doesn't work. So a great exercise is to go open your website and just start clicking on every single link that's there to make sure it's all still working and there's not any kind of updates that need to be made, and also where it's going, because sometimes links go to an outdated funnel or an outdated person's email address that no longer works for the company, an outdated phone number. You want to know all of those things so you have time to correct them. Ask past clients for reviews. If you have, some great clients that you want to reach out to, now is a good time, because you can use that in your marketing and your advertising, by end of year, that they had this great experience, and there you go. You put it in your newsletters, on your website, in your social media marketing. It's a great time to do that. And then send client appreciation gifts. If you're not doing that as a practice, it does make a big difference. Even if it's as simple as a Christmas card that's personally signed and not just, mass printed and mailed out. Now, some companies, you're not going to have that option because you have way too many clients for that to be feasible. But I tell you, it goes a long, long way. Thank you cards, Christmas cards. If you know of clients that don't celebrate Christmas and you can send them anything that's relative to their belief system, would be great. A generic happy holidays works. People love getting little things like that because nobody does it. It's all digital. You get a digital Christmas card, a digital thank you card, and they love getting little things like that. And it helps deepen and strengthen loyalty and your relationship with your clients. Last but not least, human resources. If you have updates to your employee handbook, now's a great time. From this year, now's a great time to update that and get the new signed books updated by and signed by the end of this year. So going into next year, policies and procedures are very clear. Unfortunately, especially with California and New York and states like that, Oregon, it's a very employee-friendly environment, not employer-friendly environment in the departments of labor. So every single thing you would want to reprimand, that's not the right word, but talk to your employee about or challenge them about, you have to have it in writing so that it's clear that they broke a policy about it. It's hard. Discipline. That's the word I was looking for. It's very hard to discipline someone who there's no proof or there's no information about how they broke the policy or procedure. So making sure your handbooks are up to date with what your current policies are is important. Analyzing upcoming staffing needs, because again, that's something you're going to want to put in your 26 budget or adjust about your fourth quarter budget if you need to scale back or hire. And by the way, hiring should make you 3 to 10 times what you're paying them if they're doing the job that they were hired to do, because they're either giving you your time back so you can go out and do revenue generating activities. They're bringing business with them. That's expanding the portfolio and increasing revenue. They're going out and finding the business because now you can duplicate the sales efforts by hiring them, or they're simply allowing you to focus on what you do the best, which is build the business and go out and create new streams, create new verticals, create new products, and not because you're not doing those other things that they're taking off your plate. So that's how you want to analyze staffing needs increase or decrease, but that's a big thing by end of year. No one wants to lay somebody off end of year when holidays are coming, but sometimes it is necessary for the success and health of the business to do so. Stay up to date on state employment laws. I know every year your unemployment rate will change, maybe. And also the minimum wage could change in your state. So you want to make sure that for 2026, as of that date, you have the right unemployment rate and you have the right minimum wage rate, because that also then affects your salary rates, because salary has to be a minimum of double minimum wage. So when minimum wage goes up, automatically salaries go up because they have to keep at least double. If they were at double, then they have to keep increase. If they were above double, then maybe they don't go up. But that's important to know. And a lot of states just make changes, period. So making sure you're keeping in line with those. Review any changes to employee benefits, especially if you have looked at your budget and you've realized you cannot afford contributions or matching 401k. Here's an example of where you might need to pull back on benefits. Or if you're doing really well, maybe we institute benefits now because we have the ability to do so in our margins. And then health insurance plans and 401k plans do change over time. Dental, vision, their pricings change. Then that has to be changed in the employee profile. And there is, a lot of admin work that is associated with benefits, period. Last but not least, end of year bonuses. If you are going to issue them, they are for employees, they have to run through payroll. There is no such thing as just cutting a regular check and calling it a bonus for your employees. Now, what you can do is call it a gross check, meaning for round numbers, say you want to give each employee $1,000. You can cut them a check. I'm sorry, not a gross check, a net check. A net check that gives them 1,000 even, but you actually are paying them $1,126.32, because that's the math equivalent of what it takes to get them $1,000 even. Or you just pay them 1,000, their regular taxes came out, and it is what it is. So there are options if you don't want them to receive what looked like taxed bonuses, but you do have to then pay the taxes on the bonus. It's just not an option. I have 2 audits sitting on my desk where an unemployment audit showed that employees were paid outside of payroll, and it's a big deal. So just make sure if you're bonusing your vendors, you need to make sure it falls in line with the Department of Labor standards for your state, because if it looks like you're treating them like an employee at all and you're audited, they may be reassessed. So this looks like following at minimum the ABC law, which is the standards that separate who is vendor and who is an employee. As long as you're following those as a standard. Now, state by state, their independent laws supersede the federal law. So you want to make sure in your state you understand if there's any differences. And in New York and California, there are, by the way. I don't know every state, but of what constitutes vendor versus employee. Sometimes you cannot bonus and you cannot give money outside of an invoice that you received from that vendor. Otherwise, it looks like you're treating them as a employee. Now, you could tip them as long as you're recording it properly and not making it look like employer relationship type activities. So those are my tips for end of the year. I know it's a lot in a small amount of time, but do you have questions that I can answer live?
I probably do, but that was a lot. And you, you were great. You gave me
Thank you.
a lot of thinking.
Thank
So
you. We
Yeah.
are going to transcribe this and blog and post a blog about the same topic. So
Okay.
you can rewatch the YouTube, you can look at the transcription, and you can read the blog. And those will have the bullet points of all the things we discussed. Plus, the free resource will be on our website
Okay.
in the resources area too, to help you go one by one by one.
Okay.
So we'll
Just,
try to make
just
it as easy as possible to remember it all.
yeah, no doubt. I wrote down what I could, but I'm glad that you have the transcription. That'll be great.
Yeah.
Where my team and I will be meeting with you Wednesday of next week.
Oh,
So
yay.
we're excited to
Great.
do that. And I think that just you going through this whole thing has been great. And I think that we'll have probably a lot more questions at that time.
Some pre-homework for you now.
Yeah, yeah, a lot of homework. But thank you so much. I appreciate your time.
Yeah, you're very welcome. Thank you. So the second and fourth Thursday of every month, we have our mini masterclass live, and then we always post the replays, and it's always on our website and in our newsletters as well.
Okay, thank you.
Thank
Appreciate
you.
it. Okay,
See you Wednesday.
all right. Bye-bye.
Bye.